We just got some data showing that more and more businesses are starting to run out of money. Take a look. This is from CNBC. Retailers like Peloton and Saks keep paying vendors late, signaling possible financial distress. Now, I published a video last month where I talked about how more and more Americans are seeing their savings accounts shrink, and also how a record number of Americans are pulling money out of their 401k accounts through a hardship withdrawal. But what's interesting now is we're seeing more and more retailers starting to struggle as well. This is a chart showing the percentage of Saks bills that are past due. And what you can see is that in October 2023, about 18.2% of Saks Fifth Avenue bills were past due. And then if you fast forward to February 2024, 98.1% of the bills that Saks Fifth Avenue has are past due. And if we scroll down a little bit, you'll see on these blue charts, you'll see that in January 2024, just 1.6% of Saks Fifth Avenue bills were 91 days or more past due. But by February 2024, 41.1% of Saks Fifth Avenue bills were 91 days or more past due. But Saks isn't alone here. Bath & Body Works has been seeing the same thing from December to February 2024. And even Express, the retailer, has been seeing more and more bills go past due. Now, the important thing to understand here is you don't want to jump to financial conclusions. The question you want to ask is, why are companies paying their bills later? According to CNBC, it's either that they have liquidity issues or they don't care. We talked about this in Market Briefs, my financial newsletter. But the reason why you want to pay attention to this is because either this means that companies are just trying to take advantage of paying their vendors later by accruing some interest on some savings and then paying their vendors in the last minute. Maybe even paying some late fees because they can. They have these healthy balance sheets and they're just going to pay their vendors later. That way they can accrue some more interest. But it can become a problem if maybe these companies are seeing less revenues come in, less cash come through the door, and so they want to hold on to their cash for a little bit longer. And that's one of those intentions that we're not really going to know until after the fact. By the way, for those of you that want to join Market Briefs, it's a free financial newsletter where every day my team is working to break down what's happening in things like the economy, the housing market, the stock market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. It's completely free, and you can read Market Briefs in less than 5 minutes every morning. So if you'd like to join Market Briefs, I got the link to how you can join down in the description below, or you can go to briefs.co/market. That's briefs.co/market. The reason news like this makes people nervous is because we've seen what happens when companies start to struggle with their finances and then they can't pay their bills. I mean, just take a look at Bed Bath & Beyond. In the months before Bed Bath & Beyond declared bankruptcy, the former home goods titan was trapped in a crushing cycle. They had been failing to pay its vendors on time, if at all. But the real reason why this story caught my attention today of all days was because earlier today, I was in the mall buying a gift for my wife for her birthday. And the reason why this is so interesting is because when I was in the mall, I was shopping and went to cash out. I talked to the cashier and I said, well, how's business doing? It's one of those things that I like to do. I know, I'm weird, but I asked, how's business? And she says, oh, it's been stable. I said, oh, that's good. And just trying to create conversation, I asked, is it still like that post-pandemic boom that we saw where everybody was trying to shop and buy things in 2020 and 2021? And she kind of laughed and said, no, it's interesting that you say that because, you know, our bosses and everyone is kind of expecting us to have more sales because they want to see sales rise year after year after year. But after that COVID money, we've been kind of seeing sales slow down. And I said, oh, really? And she says, yeah, I've been working in the mall since 2002. And this is actually the worst I've ever seen. Now that got me interested. I said, what do you mean? She says, well, we haven't really had that many customers over the last few weeks. Maybe it was because of Easter. Maybe it was because of the holidays. People are on spring break. But we've been really seeing a slowdown in sales and our bosses are getting a little nervous and they've been putting a lot of pressure on us to get more sales. But people just don't have money after the whole COVID stimulus. And it's hard to see growing sales after that because during 2020 and 2021, people had all this money to spend. So it was easy to sell more stuff. But now that people don't have that money, and now that people are struggling to pay their rents, and now that people are struggling to pay for their regular expenses, they don't have as much money to come to the mall and buy these secondary things. Back then, people had extra money, so they were shopping and doing whatever they wanted to do. But now, you don't have all that free money floating around. So people are now starting to cut back on shopping. So it's putting a lot of pressure on us because we're not able to sell as much stuff. Naturally, that got me interested and we continued talking. But this is where now, it's interesting to kind of see the full picture. Because from a business perspective, what also happened during 2020 and 2021 was interest rates fell to the lowest levels ever. So businesses were refinancing huge amounts of debt. They were pulling out huge amounts of debt because you could borrow money for 2, 3, 4%, which was unheard of, especially in the business space. But the problem now is interest rates are so much more expensive. And if you're a corporation, you don't get to take out a 30-year fixed rate mortgage. The debt is starting to readjust now in 2024, and we'll have more debt readjusting in 2025. Which means now if you're a business, you want to see two things. Number one, you naturally want to see revenues growing year after year after year. Every business wants that. No business wants to see revenue grow and then revenue fall. So every business wants to see revenue growing, and their projections will always show revenue growing unless there's something really wrong with the business. So every business would be forecasting growing revenues in the future. But if people are starting to struggle more because they're starting to really catch up with this higher inflation. They're really starting to catch up with the higher cost of living, and now they have to cut back because they've been digging into their savings, they've been digging into their 401k, they're maxing out their credit cards. Now they can't shop as much. That means maybe these stores, these businesses can't sell as much stuff. And if that happens during a time where the expenses are also rising, because if you're a business, you're a store, you also have to pay rent. You also have to pay higher salaries. You have to pay higher costs for your goods. And you also might be having higher debt servicing costs because a lot of businesses carry debt. And so now if your debts start to readjust, that could mean you need more money coming in order to service these debts. And you can start to see now why this could kind of create a predicament. And what we've been seeing is up until now, we still have a booming economy. I mean, people are still spending money. We've been seeing people spend money like crazy. But the problem is how people have been spending money. Like what I talked about before is we're seeing a record number of people pull money out of the 401ks through a hardship withdrawal. We're seeing a record number of people go into credit card debt because credit card debt is at a record high. We're seeing a record number of people go into their savings. We're seeing a record number of people use these alternative ways to spend money as opposed to spending money from their income. But there's only so much debt that people can take on. And if people can't continue spending the way that they were before, and businesses don't get the revenue that they were expecting during a time where expenses are also rising, that could create some concerns. Now, of course, there's a lot of uncertainty here. You don't want to predict what's going to happen because nobody can predict what's going to happen in the economy tomorrow. No one's going to predict what's going to happen next year. But what you have to understand is no economy can go in one direction forever. Our economy goes through booms and busts. This is a fact. Pretty much every decade for the last century has seen a recession. But what you also have to understand is every shift in the economy creates opportunity for the people that are financially educated and prepared. Financially educated means you understand how to find opportunities and you understand how to analyze your investments. Prepared means you have cash to fall back on. Cash means if you lose your job, you don't have to now scramble to figure out how you're going to eat. Cash also means that if you see an investment opportunity, maybe you see a good stock, maybe you see an investment opportunity where an asset price falls, you have money to go out and buy it. Because you could find the greatest investment opportunity in the world, but if you have no cash, it doesn't really do anything for you. And this is where what I want you to do is just be understanding of what's happening. Because yes, the economy is still very strong today. People have jobs today. Sure, maybe a lot of these jobs are not what people might want, but people still have jobs and people are still getting by. Yes, I understand. A lot of Americans are struggling, but people are still getting by. But if people can't keep getting by and they have to cut back more, and if they have to cut back their spending and they have to tighten their budgets, that's going to mean that some businesses are going to make less money. And if those businesses have been projecting higher revenues, and because they've been projecting higher revenues, they've been pulling out debt to their eyeballs based off of these future revenue projections, and they can't meet those revenue projections, you can start to see why this becomes an issue. And this is why I want you to stay financially educated. This is why I want you to be financially smart. This is why I want you to always have some cash to protect you, but also be able to capitalize on opportunities. And this is why I want you to be a financially educated investor. That way you can find opportunities instead of being the person that just gets screwed over by the system. But this requires you to spend the time learning and understanding what's going on. And of course, if you're looking for an easy way to stay up to date on what's happening, when it's happening, you can join Market Briefs, my free financial newsletter. And I got the link for you down in the description below. In 2023, a record amount of Americans pulled money out of their 401k accounts through a hardship withdrawal. This is people pulling money out of the 401k accounts not to go out and buy a home, which you can do subject to a 10% penalty. This is people pulling money out of the 401k accounts because they're facing some sort of financial hardship.